You have been entering trades the wrong and risky way. If you don't know these two elite exit and entry strategies that I am about to show you right now. To make money in trading, you must understand that everything you do on the charts, either in a trending or ranging market, depends on the knowledge you have in your mind. Note this, only your knowledge controls your emotions. Let's take a look at the two best ways you can enter and exit a trade like a pro. 1. Small retracements. Small retracement is a move found after a trend retracement. Many traders are always trading against the trend because they think they can make sideways profits from the market. Take a look at this chart. Is this market in an uptrend or downtrend? Even an 8-year-old kid can identify this. So many traders will look for trading opportunities at the top of the trend, and that will keep hitting their stop loss. They begin to feel so frustrated, but tomorrow they will still repeat these mistakes again and again. One of my students, on his first day in my online mentorship class, I asked him to tell me the direction of this chart movement, and he told me that this trade will fall from the top. I asked him why, and he told me that price will hit the top and retrace before it continues trending again. I asked him, "What are you going to do in a position like this?" And he told me, "I will wait at the top and take the trade." And just then, I smiled. This is a common mistake that a lot of traders make that blows up their account, and they don't even realize they do this almost every day. And it has become so consistent that it's beginning to happen to them unconsciously. Have you seen a situation like this, when the market will act as though it's falling, only for it to spike and trend continuously without stopping, or even wait for you to tag along and enjoy the benefits of the move? That's because you underestimated the power of the trend, while the bulls were really active on that market. But to avoid all of that, this is how you enter a trending market, the elite way, using the small retracement pattern, like the 5% traders do. The 5% traders don't place their trades at the front of a moving train or try to catch a falling knife. Let me explain. There are two principles guiding the small retracement entry strategy. 1. You must not stand in front of a moving train. 2. You must not catch a falling knife. Now you already know that. Standing in front of a moving train means trading against a trend. There is a term called catching a falling knife, which is where this entry strategy comes into work. When the trend decides to take a small break and retrace in order to pick orders, sometimes it keeps going beyond limits and actually lead to a change of trend. By then, you could have taken a trade that will go bad for you. Take a look at this chart. The market has been in an uptrend, and it then decided to make a little retracement move. Some of you will take this trade at this point where this candle appeared. But here is what the market will do to you. It will go down to hit your stop loss, and then continue in that very direction you wanted it to go. If this has happened to you many times, you are catching a falling knife. To avoid all these, once and for all, you will use the small retracement technique to elevate your entry game and start making real block profits. This is how it works. The small retracement move is a small price action after a bigger price action on the chart. It comes like a small double top or double bottom, and when taking it, you must make sure that the second move is higher than the first one for an uptrend, and you make sure the second move is lower than the first move for a downtrend. Waiting for this small retracement move will save you from a lot of losses, and it's very simple to identify. First, you wait for the market to retrace, then you allow it to create a big move like this one. Then you wait for the small retracement move, which looks like a double bottom, to appear. Then you take your trade after you see two consecutive bullish candles appearing at the second low. You place your stop loss below the first move of the retracement movement and your TP at the next significant high. Let's look at another example of this. On the chart here, you can see that the market is moving in a strong uptrend. Then it decided to retrace. Again, take a look at this retracement and remember what I taught you earlier. This structure first made a big retracement according to the strategy plan. It created a small retracement move, but it became invalid because the second low went beyond the first move. Even if the second low dropped below by 1 pip, it will still invalidate the entry because we are sticking to rules here. After that, the market made another small retracement movement which moved according to our conditions. First it had a higher high, which indicates a full trend change. Then it had 2 consecutive bullish candles, which complete the requirements of the small retracement move. After that, you place your stop loss below the first move and you'll take profit target at the next significant high. Then you enjoy your profits. The second entry signal is the pin bar. Pin bar is the most interesting entry signal. The pin bar helps you to not only follow the trend, but to take huge advantage from the beginning of the trend movement. A pin bar as a candlestick represents a very bullish market movement. It appears as an inverse pin bar when it's in a bearish market. This candlestick forms as a result of strong bias pushing the market upwards. When it happens, it shows that the buyers have had enough and they are overpowering the sellers to push the price forward. It's survival of the fittest, and when it ends up as a pin bar candle, it means that the buyers have won. It is similar to the inverse bearish pin bar, but opposite trend direction. When you see it, it means that the sellers have had enough of the buyers' movements and have decided to push the price downwards to their direction. When the candle ends up as an inverse bearish pin bar candlestick, it means the sellers have won. While a pin bar can work in different market conditions, it is expected that the pin bar is only used on trending markets. This way we can easily align with the trend, and that will make market movement much easier to predict. It's better to be in the train than to stand in front of the train. Let's take a look at this example. First of all, the market was trending up and it made a little retracement. Then it printed a very beautiful pin bar. If you notice on the chart, after the pin bar was spotted, the market kept trending up and did not fall back. A pin bar is a very powerful candlestick when used along with a trending market. When you have spotted the pin bar, the next step is to draw out your risk management plan. For this strategy, it is recommended that you place your stop loss just below the pin bar, just below it, because according to this strategy, the price is not expected to go below the pin bar. So when you place your trade, do it with confidence, then project your take profit target to the next significant high. Even if the market keeps trending up, that is no longer your problem. By then you have made your cool profits already and waiting for the next retracement. Here is a pro tip for you, because you are really dedicated to learn this strategy. Never take a pin bar that appears after a very long candle. It will not work. Only take a pin bar that appeared after a moderate candlestick like the one you can see on the chart. Make sure you look out for that before making your entry, so you don't lose your trade. And also ensuring that the pin bar is not just bullish in character, but also bullish in color. Never take a pin bar that is still maintaining its bearish color. Now let's see the last example. Take a look at this bearish trend example. The market was trending down, and it made a retracement. During this retracement, you were supposed to find the best spot to enter, and not to be taken out by your stop loss. The first spot did not even look anything like the pin bar, so we would have to wait for the next move. After that move came another pin bar, but this pin bar did not follow our rules. The rule is that if it must become a bearish candlestick, then it must take on a bearish color. So since it's still in its bullish state, it will be considered invalid and not to be taken as an entry signal. The third pin bar is a full example of everything that I taught you about the pin bar entry strategy. This candlestick represents a complete bearish pin bar. At first, you can see that the candlestick prior to the pin bar has a moderate size, and it's not a long candle, which is a good sign according to the pro information that I shared with you. That's the first pass. Secondly, the pin bar is not just a bearish pin bar in character, but it has come to a full bearish state, in a bearish color. Since you have seen the right pin bar, which you can join the bearish trend with, the next step is to plan your risk management. First, you set your stop loss at the top of the bearish pin bar, then you place your take profit level at the next significant low, then you wait for your profits to load up. Entering the trend with the pin bar strategy is very simple. As long as you follow these few rules, you will be able to make profits with it whenever you spot it on the chart. Trading is a business, and it can be learnt and mastered so well that you know exactly what you are doing on the charts and also know what to expect in any trade you take. Some traders spend more than 6 years in the game before getting profitable. Meanwhile, this is what you can learn in a very short time. Just a dedicated month of practice using the Blue Man Strategy 2.0 ebook. This ebook will teach you everything from the trading levels, structures and down to the entry candlesticks, and it's available for only $50 at the moment. When you buy it, you get a video illustration of the ebook for free. Check the description box below for my Telegram message link to get the ebook now. See you in our next video.